All right, accounting students, welcome. Today, we're going to tackle a standard you'll see all the time in your careers. IAS 2, all about inventories. So let's just jump right in.
Okay, so picture this. You're standing in a massive warehouse, and it's just packed, floor to ceiling with products. The million-dollar question, and the one that IAS 2 is literally built to answer, is this. How on earth do you put a single, reliable number on the value of all that stuff? Because I promise you, it is not as simple as just adding up the price tags.
So to solve that puzzle, IAS 2 gives us one single, really powerful principle that basically governs everything else. Look, if you take away just one thing from this explainer, make it this: the golden rule of inventory measurement.
And here it is, straight from the source, paragraph 9 of the standard. Inventories shall be measured at the lower of cost and net realizable value. Seriously? This one sentence? It's the absolute heart of IAS 2. Every single calculation and every decision you make comes right back to this fundamental rule. So what does that actually mean in practice? It means for every single item you have, you got to compare two numbers. On one hand, you have its cost, which is basically what you paid for it, and on the other hand, you have its net realizable value, or NRV, which is what you can realistically get for it. The rule is dead simple. You always have to record the inventory at whichever of those two numbers is lower. This is a super important accounting concept called prudence. It's all about making sure we never overstate our assets, because the last thing you want to do is tell the world your stuff is worth more than it really is. Okay, so let's pull that rule apart, piece by piece. We're going to start with the first part, cost. For the next little bit, we're going to dig into how we actually figure out the cost of an item, because you're about to see that it is way more than just the price on the invoice.
So IAS 2 breaks costs down into three main buckets, kind of like building blocks. You've got your costs of purchase, your costs of conversion, and then any other costs that were necessary to get that inventory to where it is and in the condition it's in. Let's check them out one by one. So, what actually makes it into the cost bucket? Well, it's not just the price tag. Here's a good way to think about it. Any cost that was essential to get the inventory to its current location and condition, well, that gets included. So yeah, that's the purchase price. But it's also things like import taxes, shipping fees, and if you're a manufacturer, you're talking about direct labor and a fair share of your factory overheads. Now, knowing what to include is one thing, but knowing what to exclude, that's just as critical. IAS 2 is really clear about this. You cannot capitalize things like abnormal amounts of wasted materials or labor. That's just an expense for the period. Same goes for your general administrative overheads or any selling costs. And you might be asking, why is that? Well, because those aren't costs of getting the inventory ready, they're costs of running the business and actually making a sale.
All right, here's a classic problem. What if you have thousands of identical items, but you bought them all at slightly different prices over time? How do you figure out the cost of what you just sold? Well, IAS 2 gives you two main options. The first is FIFO, or first in, first out. It's pretty straightforward. It just assumes the first stuff you bought is the first stuff you sold. Makes sense, right? The other method is weighted average, where you just calculate a single average cost for all your identical items and apply that average to each one you sell. The key is a company has to pick one method and then stick with it for similar types of inventory.
Okay, so we've nailed down the cost side of things. Awesome. But remember, that's only half the equation. We've always got to come back to that golden rule, the lower of cost and NRV. So now we need to do a reality check. What happens if the real-world value of that inventory has dropped below what we paid for it?
And that reality check is called net realizable value, or NRV for short. Now, NRV is all about estimates. Basically, you start with what you think you can sell an item for. Then you have to subtract any money you still need to spend to finish it, and you also subtract any costs to actually, make the sale. Think about things like sales commissions. What's left over is the net cash you actually expect to get from that item.
So what could possibly happen to make that value drop? Oh, just real life happening. Maybe the goods got damaged in the warehouse. Maybe they become obsolete, like last year's iPhone model. Or maybe the market has changed and selling prices have just tanked. These are the kinds of triggers that force a company to do that comparison between cost and this new lower NRV. And this right here shows you exactly how that rule gets put into action. If you calculate your NRV and find out the inventory is worth more than what you paid, fantastic. But guess what? You don't do a thing. You just stick with the original cost. But, and this is the important part, if the NRV is lower than the cost, you absolutely have to face the music and recognize that loss right away. You do this by writing down the value of the inventory on your books to that lower NRV. All right, so we know how to value the inventory while it's sitting on the balance sheet as an asset, but what happens at the moment it's actually sold? Where does it go then?
Well, that's the last step in its accounting journey.
Well, the second that item is sold and you book the revenue, something really important happens. Its value, that final lower of cost or NRV number, it moves. It gets taken off the balance sheet where it was an asset, and it reappears on the income statement where it becomes an expense. And this particular expense has a very famous name, cost of sales, or, as you'll often hear it, cost of goods sold.
Okay, we're almost there. The last piece of this whole puzzle is all about transparency. See, it's not enough for a company to just do all these calculations behind the scenes. They have to tell everyone, investors, banks, you name it, exactly how they're handling their inventory.
So what exactly do they have to put in the notes to their financial statements? Well, IAS 2 says they need to be really open about their accounting policies, like which cost formula they're using, FIFO or weighted average. They also have to disclose key numbers, like the total value of their inventory, and crucially, the amount of any of those write-downs to NRV that they recognized. All this information gives anyone reading the report a really clear picture of how the company is managing its stock. You know, are they selling it well? Is it getting old and obsolete?
And that leaves us with a really big and honestly a really important question to think about as you move forward. The cost part of our rule is mostly based on historical facts, what you paid. But NRV, that's all about making estimates of the future. So think about it. Where in this whole process does a manager's judgment and assumptions have the biggest power to affect the company's reported profit and its financial health? Definitely something to chew on.